Every year, your money buys a little less. The burger that cost £5 a few years ago now costs £8. Your rent goes up. Groceries become more expensive. Petrol prices seem to climb every year. Most people blame companies. Some blame greedy businesses. Others blame supply chains. And while those factors matter, they're not the whole story, because behind almost every period of rising prices is something much bigger, something that affects every single person on Earth: the money supply. Here's the surprising part. Most people spend their entire lives earning money without ever understanding where money actually comes from, or why the amount of money in circulation keeps changing. And if you don't understand the money supply, you'll never truly understand inflation. By the end of this video, you'll understand one of the most powerful concepts in economics in the simplest way possible. Let's begin. Chapter 1. What is the money supply? Imagine a small island with only 100 people. The island has apples, fish, bread, houses, clothes, and services. Now imagine there are exactly 100,000 pounds on the island. That means every product and every service must be bought using that total amount of money. This total amount of money circulating in an economy is called the money supply. Think of it as the total pool of money available for spending: cash, bank balances, checking accounts, some types of savings. Together, they make up the money supply. Now here's the important question. What happens if the island suddenly has 200,000 pounds, but nothing else changes? There are still the same number of fish, the same number of apples, the same number of houses. Only one thing increased: money. Now everyone has more money to spend, but there aren't more goods to buy. So people begin offering higher prices, not because products became better, not because businesses became greedier, but because there is simply more money chasing the same number of goods. That is the foundation of inflation. Chapter 2. Where does money come from? Most people think governments print all the money. That's only partially true. Yes, central banks create money. In the United States, that's the Federal Reserve. In the UK, it's the Bank of England. In Europe, it's the European Central Bank. But physical cash is only a tiny fraction of modern money. Today, most money exists digitally, and surprisingly, commercial banks create a huge amount of it. Here's how. Imagine you deposit 10,000 pounds into your bank. The bank doesn't lock your money inside a vault forever. Instead, it lends most of that money to someone buying a car. That person spends it. The seller deposits it into another bank. That bank lends part of it again. The process repeats over and over. This is known as fractional reserve banking. One original deposit can support far more money circulating throughout the economy. In other words, banks don't just move money, they help create it. Every new loan expands the money supply. That's why credit is so important to the economy. Chapter 3. Why governments increase the money supply? If creating money can cause inflation, why do governments keep doing it? Because economies need money to grow. Imagine an economy that doubles its production. Twice as many businesses, twice as many workers, twice as many products. If the money supply never increased, there wouldn't be enough money to support all those transactions. Economic activity would slow down. Prices could actually fall, while lower prices sound good. Persistent falling prices, known as deflation, can create serious problems. People delay purchases, businesses earn less, companies cut jobs, the economy slows further. To avoid this, central banks usually aim for low, stable inflation, around 2% per year in many countries. That means they gradually increase the money supply over time. Not too fast, not too slow. Finding that balance is one of the hardest jobs in economics. Chapter 4. When money printing goes too far, let's look at what happens when that balance disappears. History gives us many examples. After World War I, Germany owed enormous debts. To help pay its bills, the government printed huge amounts of money. At first, it seemed harmless, but eventually, prices began rising rapidly, then daily, then hourly. People rushed to spend their wages before prices increased again. Workers were paid multiple times per day. Children played with stacks of banknotes. Some people even burned money because it became cheaper than firewood. This became known as hyperinflation. A similar story happened in Zimbabwe and later in Venezuela. In each case, governments dramatically increased the money supply while production collapsed. The result was devastating. Money itself lost people's trust, and once confidence disappears, a currency can collapse astonishingly fast. Chapter 5. Why printing money doesn't always cause inflation. Now here's where many people get confused. If more money causes inflation, why didn't inflation immediately explode after the 2008 financial crisis? Central banks created trillions, yet inflation remained relatively low for years. Why? Because money supply is only one side of the equation. The other side is demand. After the financial crisis, people saved more, banks became cautious, businesses invested less, consumers spent less. Much of the newly created money stayed inside the financial system instead of flowing through everyday shops and restaurants. It's a bit like filling a swimming pool, but keeping the water trapped behind a gate. The water exists, but it isn't reaching everyone. That changed during the COVID pandemic. Governments provided massive financial support. Central banks created enormous amounts of money. At the same time, factories shut down, shipping slowed, supply chains broke. Suddenly, more money was chasing fewer goods. That's one reason inflation surged across much of the world in 2021 and 2022. It wasn't only because of money printing, nor only because of supply chain disruptions. It was a combination of both. Chapter 6. The velocity of money. There's another important idea. The velocity of money. This measures how quickly money changes hands. Imagine you receive £100. You spend it at a cafe. The cafe owner pays an employee. The employee buys groceries. The shop owner pays a supplier. That same £100 helped create £400 worth of economic activity. Now imagine everyone decides to save instead. That £100 stays in a bank account. Economic activity slows. Even if the money supply stays the same, prices may not rise very much because money isn't moving. Inflation depends not only on how much money exists, but also on how quickly people spend it. Chapter 7. Can inflation ever be good? Believe it or not, a little inflation is usually considered healthy. Why? Because it encourages spending and investing. If prices slowly rise every year, people are more likely to buy today instead of waiting. Businesses are more willing to invest. Workers often receive higher wages over time. The economy keeps moving. Problems begin when inflation becomes unpredictable. If prices rise by 2%, families can usually plan for it. If prices suddenly rise by 20%, everything changes. Savings lose value. Businesses struggle to set prices. Investors become uncertain. Confidence begins disappearing. Stable inflation supports economic growth. Runaway inflation destroys it. Chapter 8. What this means for you. So why should you care? Because inflation quietly affects almost every financial decision you'll ever make. If your savings earn 1%, but inflation is 5%, you're actually losing purchasing power every year, even though your bank balance grows. Investors understand this. That's why many choose assets that have historically outpaced inflation over the long term. Businesses understand this too. They regularly adjust prices. Governments monitor inflation constantly. Central banks change interest rates largely because of inflation. Whether you're buying a house, investing, starting a business, or simply saving for retirement, understanding the money supply helps explain why prices change around you. Conclusion: money isn't just pieces of paper or numbers on a screen. It's the lifeblood of the economy. When the amount of money grows at roughly the same pace as goods and services, the economy remains relatively stable. But when money grows much faster than production, prices usually rise. That's inflation. Of course, inflation is never caused by one single thing. Supply shocks, energy prices, wars, consumer demand, government policies all play a role. But beneath nearly every inflation story lies the money supply. Because if more money keeps chasing the same amount of goods, those goods almost always become more expensive. And once you understand that, you'll never look at rising prices the same way again. If you enjoyed this video and learned something new, make sure to subscribe to Mini Ledger for more videos that break down the economics, business strategies, and financial concepts shaping our world. And remember, money isn't valuable because it's printed. It's valuable because people trust it.